look, if they just own one or two properties, the level of income that they're getting may not be enough to push them into a higher tax bracket, right? They may be getting what, 40,000 a year as rental income, let's say, as an example. That's not enough to say to them, yeah, let's think about some tax planning. But when they start leveraging those properties to start buying more, a third property, a fourth property, and so on, then that's when we say to them, okay, hold on, let's take a look here. Do you plan on making this a regular occurrence where you're going to start buying more and more properties on a regular basis, like every 3 months, let's say?
Yeah.
Then we say to them, okay, hold on, let's look at the best, the being the most tax efficient, like putting them in the most tax efficient position possible.
Hello, and welcome back to the Very Real Estate Effect podcast, a show dedicated to real estate investing right here in Quebec. And today I'm very excited to have Michael Lawand, who's a CPA, so a certified accountant. And I look forward to this conversation because accounting and tax and stuff always generates a lot of questions. So hello, Michael. How are you doing?
Good, you?
I'm good. I'm excited to be here and to have this conversation with you, this interview.
I'm excited to be here too.
All right. Well, look, before we get into it, I just want to remind everyone listening, thank you for supporting us. Please leave us a comment, send us some feedback, subscribe to the show, share it with a friend who you think could benefit from this conversation. It always helps us. So there we go. So Michael, you are at Robert M. Lawand, CPA. It's a Montreal-based firm. Yes. And you've been working there for a number of years. You work with quite a few real estate investors, and I'm sure they kind of always ask you kind of the same questions and stuff like that. So I was hoping today we could take a little bit of time to go over certain questions that may seem obvious to us, but it may be new to a lot of people. Is that okay with you?
Yes, of course. So if you don't mind, I guess I'll just kind of jump in, or?
Yeah, sure. So go right ahead.
Yeah, no, I was just going to say that, I guess the most obvious question that at least our clients have, or have the ones that we do have, and people that are thinking about doing it, the most obvious question they've had is, well, how do I save taxes, right? Like,
yes, we all agree on that.
Have that question. Yeah, no. Right. So I guess the most obvious is, depending on the amount of income you're earning, that's where you have the question of, do you do it in your name, in the company? So that's kind of the most obvious starting point that we look at.
Okay. So depending on your personal income, like what you make from your employment or other sources, whether you should decide to put in a company or invest in your own name.
Yeah. Like I know that we, like, as an example, we have a couple of clients that have a fair amount of real estate. They own a fair amount of real estate. And
when you say a fair amount, like roughly how many units?
I think in terms of buildings, they own, I think, at least 10.
Okay.
In terms of how many units in each building, I'm not sure how many units are in each building, but
that's fine. That's fine.
Yeah. But yeah, when you get to that level, the amount of income that you're generating from that as rental income and as potential gains when you sell the property, they could be thousands or hundreds of thousands of dollars.
Yeah.
So that's where a little bit of tax planning comes in handy.
Definitely. So when you get a new client who happens to be a real estate investor, and they come in and see you and they want to talk about planning, kind of like, where is a good place to start? Because there's a lot of people that may just own like a triplex or 6 units, but they're growing, and those are important questions for them. So what is it that they should think about at the beginning?
I mean, look, if they just own one or two properties, the level of income that they're getting may not be enough to push them into a higher tax bracket, right? They may be getting what, 40,000 a year as rental income, let's say, as an example. That's not enough to say to them, yeah, let's think about some tax planning. But when they start leveraging those properties to start buying more, a third property, a fourth property, and so on, then that's when we say to them, okay, hold on, let's take a look here. Do you plan on making this a regular occurrence where you're going to start buying more and more properties on a regular basis, like every 3 months, let's say?
Yeah.
Then yeah, we say to them, okay, hold on, let's look at the best, the being the most tax efficient, like putting them in the most tax efficient position possible.
And then so for someone who's buying, let's say, 2 properties a year, obviously it depends on their other income, but like, would you recommend that they start to put it in a company? Because then it really does become a business at this point.
Well, that's it, right? It may be advantageous for them to, from the outset, to put it into a company, just because, like you said, like they're in a position where, yes, they plan on making this a regular business, and the tax rates overall in a company are more favorable than if they were to be taxed in their own name personally. Because as you know, like the tax brackets, personal tax brackets can be, the lowest one is 15%.
That's for like 32,000 a year or something like that.
Yeah, right. And then you get up to almost half, for the highest tax bracket.
Okay, so that would be an important place to start. Then obviously these people hold those properties for a while. They build equity over time.
Yeah.
Then obviously there's capital gains.
Yes.
Once they dispose of. So I'm sure you've had to do the calculations a lot, obviously on the capital gains, but someone who wants to take equity, like we've all built equity over time. Like, how would we tap into it?
Well, I mean, you don't necessarily have to sell the property to take that equity out. I mean, one viable option. Now, obviously, this is not necessarily something that I've done myself because I'm an accountant, right? Like I do the number crunching. But one viable option is to refinance a property. Now, in terms of the nitty gritty of how it's done, I wouldn't know the first thing.
Okay.
But I know the basic idea is that you're taking whatever equity you've grown in that property and basically putting a mortgage on it.
Yeah.
And
you're going to go get a loan bigger than what you had before, and that allows you to take some of that equity out and reuse it for something else. Yes.
Yeah, exactly. And the good part is that mortgage, like that product that you're getting, the interest is deductible.
Correct.
Because you're using it to, like for investment purposes.
Exactly. Because you're using it to buy an income producing asset.
Yeah, exactly.
Okay. So that's one of the ways to go about it. Now, there is an element that's generating a lot of questions is depreciation.
Yes.
Now, for a lot of people, it's extremely abstract in terms of what it is and should we take it, and can we kind of go over like how, what is it and how does it work?
Yeah. So basically, depreciation is, I guess, to globalize it, it's like a paper item, but it's supposed to represent the general wear and tear that's supposed to have taken place on the property that you own. So a general, like for instance, for buildings, the general rule is to use 4% as the rate that
So
you're going to
4% of the appraised property value?
Yes, or sorry, 4% of the cost. Well, like whatever the cost, like whatever your cost was.
Yeah.
That's what your initial starting point.
Okay.
So then you take that and take 4% of that, and that's your depreciation for the first year. Then the next year, it's the cost less that first 4%, and take 4% of that,
Okay.
of that new lower amount.
Yeah. So in year two, it's 4% of the 96%
Yeah,
left. Okay.
yeah, exactly.
Okay.
Exactly.
Okay. And so, but so what's the advantage to do that? Because then when you sell the property, that amount actually comes back to you.
Yeah, exactly. So the advantage in the short term is that you're helping defer taxes, because that depreciation is in, like, it can be like, it's like the expense
Mm-hmm.
that you can use to reduce your profit for the
Okay.
year. So in any given year, yeah, you're saving taxes by that amount, whatever that amount of depreciation is. But then, like you mentioned, whenever you sell the property, that gets recaptured, or like it comes back, so it gets added back, and so all the taxes you've saved over the course of owning that property, you're paying at the end. So it's like, it's in the long run, there's no not necessarily an advantage per se, but in each year, the advantage is that you're saving the taxes in each year, so that by the time, in principle, by the time you sell the property, like, in a perfect world, you're not going to sell the property till, for a while, right?
Yeah. 15 years from now.
Yeah, right. And hopefully by then you're at a point where your income is at a level where you won't be taxed so high.
Mm-hmm. Okay. Okay. So then the point of depreciation, if I understand this correctly, is really just to defer taxes until the sale of the property.
Yeah, yeah, exactly.
Okay. And then if you, let's say, so for a lot of people that do some optimization, so let's say they buy a property for 500,000, they'll put 100K into CapEx. So then their cost is 600,000.
Yeah.
Obviously in their first year, they've had a loss because they've invested quite a bit into it. Then they would start taking depreciation in year two. And then
no, like, so you would take you could take depreciation in the first year. The only thing is, you can't put yourself into a loss position with depreciation.
Okay.
So, like, if you're already in a loss position, then yeah, like, you can't take depreciation. But if you're already earning rental income in the first year, even despite all your, the initial costs,
yeah.
The cost and investment, then yeah, you could conceivably take depreciation as well, but it'll only bring you down to like a net zero. Like, it'll put you into a even position.
Yeah, it'll put you as zero. So you're saying you can't use depreciation to artificially make a loss.
Yeah, exactly.
Okay, that's fair. I mean, that's
Yeah.
understandable.
Yeah.
That's understandable. Okay. Okay, good point. So, okay, I'm glad we talked about depreciation. Do you always recommend your clients take it? Because what if someone has been investing? So same thing, same example, bought a property, 500, they've invested 100K into it. And then every year they've had to do a little, invest, okay, new windows, new roof, this and that. And so at the end of the year, once they've accounted for all the expenses, but debt servicing, they have like, a couple of $1,000 at this point. Is it even really worth it to take it?
Yeah, that's it. Like, we kind of look at it on a case by case basis and see, like, okay, how are they in a position before they even take depreciation, right? Like, what position are they at, and then we kind of judge from there.
Okay, yeah, it makes sense. So that, yeah, as you say, it's really on a case by case basis, on given on the person's personal situation, the investments.
Yeah.
Okay, all right. What other big points are there that real estate investors should be conscious of when buying rental properties?
I mean, I guess the other main point to look out for is the differentiating between investment income versus business income?
Okay.
Are they investing in the property for the sake of turning around and selling it right away and then buy another property and sell it again?
Okay.
Or are they buying the property, sitting on it, renting it out, getting rental income, and then repeating that process?
Okay, I get it. That's that's a very good point.
The taxation is slightly different depending on the type of income.
Yeah. Okay. And
I mean,
so,
sorry to interrupt you. Like, just to add to that, it's more key when it's in a company, like the differentiation between investment income versus business income. Personal tax, it's all the same. It all goes into the same pot, right? But if it's held in a company, that's where the differentiation is key, because there's a different tax rate for investment income versus regular business income, like active business income.
okay, but this is where it can become tricky, because things can change in real estate, and we may be buying a property thinking that we'll hold it for a number of years, and then something happens, and then finally, like after we've just did some renovations, and after 6 months or a year, we actually want to cash out because we're moving, or because whatever, something happens. So
Yeah.
then would someone be taxed on an active income basis?
Well, I think they'll look at the trend, right? Like, yes, okay, like you said, the person might be in a position where initially, yeah, they wanted to rent it out. Situations change, they have to sell it. But if that's the only time they're selling it, right, then it may not be considered active business income.
Okay.
It may be considered a capital gain, because they had to sell it that one time.
Okay. Yeah, you're not doing this 4 times a year.
Yeah.
Okay.
Right. Where we've seen it, and especially lately, on as part of the personal taxes, everyone's has there's a separate form that everyone has to sign saying that they didn't sell their house, they didn't change use of their principal residence, all that, because what people were doing is that they were buying and selling properties on a regular occurrence multiple times in the same year, and they were claiming that each of those properties was their principal residence.
Whoa. Okay.
So they can get away with,
Wait, yeah.
like saying that it's like, so they don't have to get the capital gain.
Okay. There's really a lot of people like moving multiple times a year and claiming that each one is their principal residence.
Yeah,
I mean,
like,
if you live there
obviously, I don't have
3 months, it's obviously kind of a flip.
well, that's it. Like, obviously, I don't have the numbers in front of me, but obviously it's happened enough that the government has kind of clamped down over the last few years to say, here, like, start having people sign this form to say that they're not selling their property, like, or change the use.
Okay. And is that mandatory for everyone? It's
Yes.
only if like you've moved within the year or
No,
changed
like
residence?
everyone has to fill out this extra form to say, I still live at that. Like, it's like 5 questions.
Okay.
But basically just like, it's just saying that you're still at the same place, you haven't changed its use, like that. That's yeah.
Makes sense though. I guess I'm thinking of like the hardcore flippers that are trying to do that multiple times a year. I mean, it might work like once or twice, but then someone's gonna light up and say, "Hey, buddy, this is active income."
That's it.
Yeah, you're just
right. And it's not like in and of itself it's an issue. It's that people are trying to say that it's their principal residence each time. Like, fine, you want to save the taxes, that all the power to you, but there's other ways of doing that.
Yeah. And at the same time, you should be taxed too. Like, it is, I was gonna say, it is what it is, even though we are all trying to minimize the impact of the tax man.
That's it.
So for people that are currently real estate investors, would you have some advice for them? Like, obviously every year when the budget comes out, some rules get changed. Is there anything in the new budget that we should be aware of that could have an impact?
Ooh, that's a good question. I haven't completely read up on every detail of the budget, so unfortunately at this particular second I don't have anything to update.
Okay.
But yeah, I mean, I guess in general it's just make sure you're, keep ahead of things, right? Like don't wait till the last second to be like, oh, wait a minute, I'm gonna buy this other property and it's gonna put my income that much higher,
Yeah.
like maybe if you know in advance, like enough in advance that you're gonna potentially buy another property that's gonna put your income over the top there, like to the next tax bracket. Like this is if you're doing it personally, right?
Yeah.
Then yeah, it's definitely good to do some tax planning in that moment to say, okay, how do I mitigate the potential tax hit, that I'm going to face?
Hmm. Yeah. And it just always comes down to like plan ahead, plan ahead,
Yeah,
plan
well,
ahead,
that's it.
and talk to a
And
professional prior.
well, that's it. Especially if you're doing it in your personal name, right? There is ways that you apply RSPs, so something like
Mhm.
that. You can, the contribution helps reduce your overall income, like stuff like that.
Okay.
But in terms of buying properties, I guess the main point that I could probably keep going back to is, depending on the number of properties and depending on the level of income, is it worth it to keep it in your personal name? Maybe consider putting it in a company.
Yeah. Yeah. Okay. Well, that's all really good, useful advice. Thank you very much.
Okay.
If people have questions and would like to find out more about you, what's the best way to get in touch with you?
I mean, we don't have an actual website per se right now, but they can call me. I guess I can give my number.
Sure.
514-381-5957. I'm an extension 104, or you can actually send me an email. My email is pretty simple. It's just my name. It's michael@lawand.ca, Michael @lawand.ca.
Perfect. Well, look, people will probably be reaching out again. It's always an area that has a lot of questions. So, Michael, thank you very much for your participation today. It's
Thank
been
you
a
for
pleasure
having
to
me.
have you.
Thank you for having me.
And to everyone listening, keep being active, research your market, make some offers, and we'll talk to you next week. Thank you.